20 to 25% of businesses sell successfully. That's abysmal. And we're here to improve that ratio. Here are 5 steps to sell successfully your business. The first one is assess. The second one is to set your objectives. The fourth is to find buyers. The fifth is to close the sale. Assess your situation. When you're assessing your business situation, it's good to understand what your own thoughts and feelings are about selling your company. Are you ready to let go of your baby? Having discussions with your business partners, with your management team, key employees, and most importantly, your family, because it's going to be a change for them too. Also, what are your goals post-sale? What are your goals for your business? Do you want to maximize your takeaway cash? Do you want to protect your employees? Do you want to make sure your customers are taken care of? Or perhaps it's some of all three. You need to know that up front because it's going to dictate the planning and the process you're going to go through. And also market conditions. Sellers can achieve a 71% higher sales price if they assess their business and plan their sale before they get into the transaction. Think about that. So some planning up front can really help you. If you want a higher business valuation, you need to identify and address the gaps in your business. What does this mean? What are gaps? Gaps are for a particular part of your business where you could be versus where you are. Unlocking the potential in a part of your business helps your bottom line. So, how do you do that? We provide methodologies where you examine various company areas, up to 20 company areas, or any relevant subset. What does that mean? We ask questions, we talk to you, your management team, your employees, we gather information, and for areas like financial, your culture, management, your technology, your customer service, we look at what you do versus best practice, industry standards, what your competition is doing, and from that we can identify gaps. Gaps where you can improve what's going on in that area of the business so that you can improve your bottom line. A word about cybersecurity. Any company, any digital company, has cybersecurity concerns. Studies show that small and mid-market businesses do not address cybersecurity, thinking that they are below the radar, and they are not. Cyber criminals get information from all different sources to satisfy their customers. They go shopping, and you could very well be on the list. Your IP, your customer list, other things that distinguish you from your competitors. So you need to be thinking about that if you have any digital aspects of your business, and nearly every business is a digital business these days. In order to understand where you're at, you need to understand your current company valuation. How much is it worth? How much can you get for it? Valuation is made up of 2 kinds of factors. One, those beyond your control, and those that are under your control. Things that are beyond your control are things like the economy, number of competitors, industry cycles, the political and regulatory environment. Things that are under your control are things like your management. How scalable are you as a company? Can you walk away and still have your business function successfully? Overdependence on a particular customer. If one customer makes up more than 15% of your business, you need some more customers. Or if you are overdependent on a supplier, if you only have one supplier, you need to get some more suppliers. These are the things that you look at. Next, set your objectives. It's important to have an experienced team if you're going to sell your company. First, studies show that most sellers sell a company perhaps every 7 to 10 years. So, given that selling your company is a complex business and you don't have a lot of experience at it, typically it's good to have some experienced help. Also, somebody's got to make sure that the company keeps running successfully while you're going through the process, because the process can take months. The last thing that you want to have happen is before you close, you've suffered a drop in revenue because you were so busy selling your company, you weren't able to pay attention to the day-to-day. Also, a team brings a diverse set of skills that you need. The M&A advisor, and we fall into that category, can help with the overall process. Financiers and bankers obviously bring the money, but they bring other things as well. Lawyers handle the legal. The advisor, the financier, and the lawyer can also help you find buyers through their networks. That's part of their job. Accountant helps keep your finances straight and also make sure that they are truthful and presentable to the buyer. Wealth manager helps the seller, you, either minimize or pay no capital gains tax on the sale proceeds. That tax planning has to occur before the sale to minimize that. And a business broker, if your valuation is $5 million or less, then we partner with brokers who can help you sell your business. It's important that you perform financial planning. I'm singing your song, aren't I? I see you nodding in the back there. First, the after-tax cash resulting from the sale. So, what are you going to do with it? Are you going to invest in another business? Are you going to blow it? Are you going to invest it in the stock market? It's good to have a plan. And also how it fits into your financial plan. How do you prepare the money so it's ready for your family? And how do you prepare your family so that they're ready for the money? If you hand someone a $500,000 check, a son or a daughter or a cousin or whoever you're going to give the money to, do they know what to do with it? So it's important to plan these things and think about these things ahead of time. Let's talk about filling in those business gaps. So you've had the assessment done on the pertinent areas of your business. Now, what do? You fill them in a prioritized kind of way. So what are the most important things that a buyer looks for in a business that they wish to acquire? One of the things, of course, is your finances, your top-level cash flow and your bottom-level profit. Growth potential and scalability. How fast and how successfully can your business scale? Do you have a business model which can be scaled? We talked about overdependence. How is your recurring revenue, and can that be increased quickly? What is your unique value proposition? How do you distinguish yourself from your competition? And then your customer satisfaction and retention. Are you spending a lot of time and money chasing after new customers because you can't keep the ones that you have? You're able to get new customers in quickly and reliably. Plan the sale. There's some things to think about. First of all, what kind of buyer do you wish to attract, strategic or financial? And there's definitely differences between them. With the strategic buyer, they are going to make your company part of their company. They're looking for acquiring your IP or your customers. They want to get into the market that you're in, which is a new market for them. So they're going to incorporate you and hold your company indefinitely. Your strategic buyer can be your competition, it can be your customers, it can be your suppliers, among others, versus the financial buyer. The financial buyer is interested in your cash flow, first and foremost. They are going to make an investment by buying your company. They're going to do certain things to improve it, and they're going to flip it within 3 to 7 years to meet their return on investment requirements. Your financial buyer is going to be venture capitalists, private equity, ultra-high worth individuals, and others of that ilk. So you can see that these two buyers have very different goals, and they're going to do very different things with your company. Will you be staying with your company after sale? Will you continue on as the CEO? This is a very important question. Do you want to stay on, or are you done? Can you live with the new owners? So all these questions are important to understand. Is now the right time to sell your business? Your own personal timing, the timing of the markets, these questions, again, are important to understand. Structure your transaction. Now, there's lots of ways to sell your company, and our job is to make sure that you get the maximum multiple for your company. So whatever works for your company is what we'll do. The first is a negotiated sale, and that's basically a sale between you and one other buyer versus some type of auction, which is targeted auction, say between 15 and 20 buyers. And yes, you are working with several of them at the same time, or an open auction where there could be many buyers. And again, your team is set up to help you with that. That's one of the things they need to help you with. Also, they help pre-qualify buyers. Sometimes you encounter people that just want to kick the tires, and they are not going to buy your company, and they're not qualified to buy your company. So nobody wants them to be wasting your time, your valuable time. So your team is there to help screen the buyers to make sure that they are qualified. Identifying potential buyers. You want multiple buyers. You're much more likely to achieve your targeted sales price when there's a competition for your company, quite frankly. One thing that needs to be developed is a pitch book. And basically, this is a set of marketing materials for your company. Humans are visually oriented, so these need to be professionally produced. They need to be attractive to the eye, and they present your company in the very best light. Pitch book includes things like company history, capabilities, your team, your growth opportunities, competition, IP, and high-level financials. So your buyers can be your competitors, your customers, private equity, and so forth. So there's a lot of different kinds of buyers, so this is why you need to plan the sale. establish a data room. In the old days, this used to be an actual room or vault that people would go to in order to access business documentation about your company. This includes legal, financial, could include information about your IP, your HR practices, your marketing, customer, and sales data. Now, they're often virtual so that they can be accessed remotely if you have the appropriate credentials. Having a data room is a great forcing function because it helps you, if you don't already have your act together documentation-wise, it forces you to do so. And this is very useful for other reasons that we'll see here in a moment. Again, these are designed to present the seller, you, in the most positive light. We're not talking about lying here or any untruths, but to have a more positive presentation. Review these documents before they are released to make sure that they're correct, consistent, and is providing to potential buyers the messages that you want them to have. Find the buyers. So, before you start answering buyer information requests, you need a confidentiality agreement. And this is very much like an NDA, except that it will have more clauses about keeping your conversations under wraps. You can imagine what would have happened if Yahoo had publicly announced that they were negotiating with Verizon before the deal was done. It probably would have scuttled the deal. So figure that your CI is going to include basically a gag order. You do not discuss your negotiations with your buyer publicly or anywhere else except with buyer personnel. So, but other than that, it's very much like an NDA. When you are contacted for information, respond promptly. This is so important. First of all, it shows that you take the buyer information request seriously and you look like you have your act together because you've already gotten all your documentation together. You don't have to scramble around trying to find last year's tax returns or that sales data from 2 years ago. Once the first round of negotiations is successfully completed, often you will receive a letter of intent. Basically, this outlines the major points of the deal. This enables both parties to make sure that they have an overall understanding of what they're talking about so that further negotiations can take place. So the letter of intent includes things like price, earnout. Earnouts are essentially payments provided in the future in response to performance goals that are met. Let's say you want to make sure as the buyer that the seller's sales are going to keep increasing at 20% a year. So you're going to want to put an earnout in your letter of intent to help make sure that continues to happen. What happens with key employees? And that can be your management team, that can be particularly valuable employees. How due diligence will be conducted, and we'll get into that more in a moment. Shareholder approvals, any demands that the shareholders of the buyer has, they go in here. Exclusivity, this is very important. Essentially, with accepting an LOI, you agree that you will not be negotiating with any other buyers during the time that you are under this LOI, that you will only be negotiating with one buyer. Who's going to handle expenses on both sides? Closing conditions. For example, let's say that you have a particularly important customer and your buyer wants to make sure that they remain your customer. So they're going to want to make sure that that contract is updated and carries through, say, 2 to 5 years beyond the sale. so that you don't suffer a precipitous drop in sales after the transfer of the company occurs. As negotiations move forward, the final acquisition agreement will be drafted. It includes all the tenets of the LOI as well as other clauses. Again, it is important to fulfill information requests promptly. During this time, the buyer will want to be conducting due diligence. It comes in a couple of forms. So one form is the paper check, what we call the paper check. And that's your legal and financial due diligence. And what we're talking about here is it's not just your data room. Your buyer will want to talk to you, your management team, your key employees. They could also want to talk to your customers and your suppliers. However, if they only look at financial and legal areas, that's the paper check. They don't go any further. However, many buyers know better than that because they know that as they look more deeply, they can be more confident that they aren't buying hidden liabilities, because that's one of the buyer's biggest fears, is that they close on the deal and there's a gotcha. And it's going to cost them time and money, and it's going to derail the reasons that they bought your company. So other areas like what we've talked about is where your buyer is likely to do more due diligence. But since you've already done the assessment on your company, you know that you have already exhumed all the bodies and disposed of them. You've already made the improvements that you needed in order to get top dollar for your company. And as the buyer continues their due diligence, now they are much more confident about going forward, concluding negotiations, and buying your company. So you've really set yourself up for success here because you've already done your own due diligence, essentially, which is called reverse due diligence, but you get the idea. So that means that on your side, you need to make your personnel available. Close the deal. After all the hard work, after the months of sometimes grueling negotiations, you're ready to close the deal. Negotiate your terms, the offer, and the contract. So the contract gets firmed up as you move through negotiations. And some major areas, of course, are not only price, but considerations. Okay, so how are you going to get paid for your company? Will that be all cash? Will that be equity in the buying company? Will that be stock in the company? Or other means? I want to go into seller and buyer representations and warranties for a moment. What does that mean? It means that you will be required to verify and warrant that you have told the truth about your company's performance from a financial point of view, with respect to your IP, and other areas of your company. This helps give the buyer further confidence that you are telling the truth and that what they see is actually going to be what they get. Now, there can also be reps and warranties on the buyer side. For example, that the buyer is authorized to buy your company and that they actually have the financial wherewithal to do so. So it can protect both, but you need to expect this. So again, it's a really important thing to have your documentation and records in place, up to date. Yes. Employee and benefit issues. Here's where if you're worried about your employees, this is where you can protect them. And let's say you don't want anybody to lose their job for a year after the sale closes. This is where you go. This is where that goes. And also, any benefit issues, if you know that their benefits, their health insurance, life insurance, or other benefits are going to change, this is where they are outlined. Also, the agreement includes termination clauses. If certain things do not happen, this deal is null and void. Closing and post-closing conditions. Closing conditions can be that customer contract needs to be re-upped for another 2 years, and that needs to happen before closing can occur, for example. Also, you're going to be participating in integration planning. What does this mean? So, that company that's buying you, let's say you're being bought by a strategic company, and they are going to bring you into the fold. Well, you've got back office systems that you're using today for HR, your CRM, your customer service systems, all your data. How does that get integrated with the buyer's data? How do the personnel shake out? What does that new company structure look like? Whose jobs are going to change and how are they going to change? All these things have to be addressed in your integration plan. So that gets worked out, and the money and the time that it's going to take to do that are also having to be set aside. This is a non-trivial exercise. So a company that we were talking to earlier this year, they wanted to merge 2 subsidiaries, wholly owned subsidiaries, right? And at the time that we talked to them, they thought that it was going to take them 4 months to perform the integration on these 2 companies. And when we spoke with them in February, they were in month 5 of a 16-month, what they belatedly realized was a 16-month integration process. So it's really vital that you plan this and that you understand what you've got to do before you get into it. Obviously, they did not plan that. So if you thought that you were going to make X amount of dollars out of the deal, and it turns out it's going to be less than that because of integration, then there's some additional work to be done there. So we've gone through our sell-side process. We assessed our situation, we set our objectives, we planned, we found buyers, and we closed the deal. Traditionally, M&A, mergers and acquisitions, has only been focused on the transaction itself. And from that yielded the 20 to 25% success rate. We're here to help. Feel free to set up a 30-minute initial consultation with us, gratis. Please contact me for more information.